Keep in mind, we're looking at fast-moving developments, but relative silence at this hour from U.S. Congress members. That could change in the coming hour, but what we know now, let's get it all together with our floor show guest, Bill Smead. He's founder and chief investment officer of Smead Capital with $7 billion in assets under management. He is joining us live. Bill, looking through the lens of both U.S. and global markets and what we know today with our futures and the response with the other markets, how are you viewing these developments?
Well, in general, you know it's disruptive, extremely disruptive. Almost every sector of our portfolio in one way or another has been disrupted by either the temporary or more permanent ways that the president is trying to adjust the economy. And it creates a lot of uncertainty. And our primary concern with it isn't whether it's a good idea to do these things. A lot of them have been good ideas. It is the fact that this is the most expensive market of my 45 years in the business, and therefore the risk in the disruptions as it pertains to the United States stock market are way higher than normal.
And you start to see it as well. We should look at the U.S. dollar because it traded overseas. And what you saw was the euro versus the dollar. The euro was spiking earlier, and you see the dollar coming off what had been sort of a climb back from a loss after 5 moves higher. So right now, all the major foreign currencies are higher against the greenback. $1.16 is what it stands at with the euro. So let's just talk about how investors should be looking at this situation as it develops, because from hour to hour, it is changing.
Well, first off, Liz, the devaluation of the dollar is actually where we're going to end up heading, because to pay the massive amount of money that the federal government has borrowed in the last 5 or 6 years, it's only wartime has ever come close to how much it is. You want to pay it back in cheaper dollars. And I think that gold and silver are telling you the story on that. It's gonna get paid back in cheaper dollars, so people would rather own gold or silver rather than a treasury. They're like a valve. You know, they're a valve that releases pressure, and so it's inflationary pressure. Ironically, we have a chart that shows that as of 2020, at the peak of the COVID scare, commodities were the cheapest relative to common stocks for 220 years. And the prior episodes were bottom of the Depression, 1825, 1875. So the fact that a series of commodities, first oil went way up to 125. Now you're doing gold and silver. It should be a bit of a rotational thing when it comes to the commodities. We happen to like oil because it's an addictive legal drug.
Well, I get it. But if we're looking at actual stocks, we had done a segment, I want to say about a month ago, saying that European defense stocks would be a real play because of the tensions between the U.S. and Denmark over this Greenland situation. And on top of that, what's going on in Ukraine? Clearly, the president has not been happy with how much or how little NATO members had been contributing to the NATO pot, so to speak. So now you see BAE Systems. They've just been actually looking pretty healthy. BAE Systems, Rheinmetall, Airbus. Some of these names look like real opportunities. Where would you be going at this point? And would you simply just stay with U.S. large cap or go away from that because, as you say, they are overvalued?
We're a little bit biased because we have a large cap international fund, which, by the way, ripped the cover off the ball last year. So we're happy to make some money on that side of our company as well. But Liz, here's something to think about. The old saying is, why did Willie Sutton rob banks?
Because that's where the money is.
That's where the money is. So let's just say that tech has had its biggest run in history. Momentum's had its biggest run in history. Growth has had its biggest momentum run in history. When somebody wants money, to get money, they have to go get it out of there. That's where the money is. The money is in the 10 largest cap stocks in the S&P have the money.
Well,
now,
let me just jump in, Bill. Let me just jump in. One of them, NVIDIA, is also having a trade issue of its own. The Financial Times is reporting today that China is blocking Chinese companies from ordering the H200 chip that's made by NVIDIA that was approved by the U.S. for export to China. This could be a real issue starting tomorrow, perhaps. We don't know how NVIDIA is going to trade. But again, all of these issues coming to a forefront, could that mean that the tech trade is toppy and is perhaps ripe for a sell-off? Quickly.
It's been showing a lot of signs of that, Liz. The subject is the reason everyone loved the big wide moat tech companies was that they were generating massive free cash flow, right? They had very little reinvestment expense. And what's happening now, they're having to be massive investors in their chip partners and their AI partners, and are now not producing the kind of owner earnings that, of course, Warren Buffett would talk about he likes so much, right? Which is your free cash flow minus your capital spending and your employee option exercise expense, which, by the way, people don't do a great job of backing that out.
Well, so far we haven't seen it, but we got to run because of all of these headlines. But Buffett, has been right over decades. We shall see. Bill, thank you very much for joining us.
Thank you.